Invest Smart with Steadily. I am Alex Reeves, brand marketing lead for Steadily Insurance. And today we are so excited to have Amanda Han and Matt McFarland, who are CPAs and tax strategists who specialize in helping real estate investors use their real estate to help save massive amounts of money on their taxes and keep their hard-earned money. So Amanda and Matt, welcome to InvestSmart. I'll give you all a second to introduce yourselves.
Oh yeah, thanks for having us, Alex. Appreciate it. Excited to be here.
Yes, well, nice to meet you. My name is Amanda Han. I am a real estate CPA.
And I'm Matt McFarland. I'm also a real estate CPA. Our firm, Keystone CPA, is located here in Southern California. We specialize in working with real estate investors all over the country on proactive tax planning advice and kind of ways to keep more of your hard-earned money, obviously.
It's the most important as an investor myself, and we're tax season's upon us, so everybody's kind of looking for what are the best strategies to save on your taxes. And today we want to talk about landlord insurance, which is obviously our what we are known for, and just taxes and what are some of the things that we can deduct regarding insurance and any type of those related expenses. So we'll just kind of dive in, but starting with the basics, what types of insurance premiums can landlords typically deduct from their taxes?
Yeah, I mean, the stuff we typically see, obviously, is just kind of the normal, you know, what you would call like homeowners insurance, but for rental property owners. They also have mortgage insurance premiums, right? That's also a deductible thing. Um, Sometimes,
Earthquake.
yeah, earthquake insurance, fire insurance, which is going to be going away in Southern California in the next 2 weeks, obviously. Um,
Which is not funny.
it's not funny, but it's one of those crazy things. But and sometimes you'll see umbrella insurance policies. Investors will have umbrella insurance. Now, those you have to be a little more careful because those are obviously going to cover probably more things than just your rental properties. So something like that is probably going to be taking a prorated amount of the expense that you can, kind of reasonably apply to your rental properties would be reasonable, I think.
Yeah, I think one quick thing, we always get questions about what can I write off? Is this deductible? Is that deductible? And whether we're talking about insurance or anything else, one quick thing or tip, right? One quick tip you can do is to ask yourself, is this expense ordinary and necessary to my real estate investment? So as a landlord, is it ordinary for me to have landlord insurance? Yes. If so, it's probably deductible. Is it necessary for me to have earthquake insurance? Probably if you're in places that have earthquake prone or floods. So that's a little tip, because people are always wondering, like, what can I write off?
No, I think that's great. And it's kind of on that same note, but just are there common misconceptions or mistakes that people do make maybe when they're not going through a tax a tax expert like you guys' firm, that they make, like that you guys see maybe when you're reviewing taxes after the fact?
Yeah, I mean, I think the biggest one that we probably see is people missing out on deductions, right? So they're, there's various reasons for that, right? It's maybe they don't understand what they can deduct. But a lot of times too, it's maybe from not being as organized as they need to be, right? So they forgot that they paid something, or they're trying to go back 12 months later and recreate financials, and they're just overlooking things that maybe they pay with personal funds, but it was related to a rental property. They forgot to look over there. There's various reasons for it, but I think that's one of the big ones that people just missed and often overlook deductions.
I think another reason it's missed a lot. It's interesting because when we first work with a client, one of the things we do is to review tax returns from previous years. And believe it or not, the two things we look for that are frequently missed is insurance deduction and property taxes. And those are things that we know, well, it's 99%, maybe 100% of landlords actually have. So I think, Matt covers some of the reasons why people miss it. I think another reason is, especially for people who don't self-manage, a lot of times if they have a property management company handling their properties, they'll just take the management report and that's what they use for tax returns. Well, guess what? If your property management company is not paying your insurance expense, it's a very high likelihood that it's missed on the tax return. If you're
Or not paying your mortgage payment. I mean, so sometimes people, believe it or not, forget about that too.
That makes sense. Those are important. And then, I mean, really topical right now that we've had incredible damage from hurricanes. We've had the fire claims, obviously. And then just typically, I mean, what we see honestly day in, day out is like just water damage claims. So when you have a claim, let's kind of, dig into that of just those reimbursements and when the money is coming back to you paid for the, reimbursed by insurance. How do those reimbursements impact taxes just in general? And, we can just use kind of a typical like burst pipe scenario. So you're going to have a deductible that's maybe paid. Let's just say it's a $20,000 claim. You've got a $2,000 deductible. We can kind of walk through of just you're replacing floors, you're replacing, some drywall. What are those things the reimbursements that come to you? What are those things that are tax deductible?
Yeah, typically, in most scenarios we see those reimbursements are not going to be tax deductible. So for like when we're talking about a rental property, what's going to happen is they got their property, they paid, pick a number, $300,000 for it all in originally, right? And they've got this $20,000 of reimbursement or damage. What's going to happen is that reimbursement's going to reduce their what we call their basis in the property, so it's not taxable to them. But now, so that's if the now to the extent they also spend money to kind of fix it outside of insurance, that would increase the basis for the property. Usually, the only time that insurance reimbursement might be taxable is if it's more than the basis of the property. So in my example, $300,000. If you had $400,000 reimbursement for some reason, then an excess $100,000 might be taxable, but there's also exceptions to that. Did they spend that money on fixing up the property? If so, then it would reduce what was taxable. So it kind of depends on the scenario, but in most situations like you're describing, it's not going to be taxable to somebody. It's just going to be kind of a reduction of their basis or, something like that.
Yeah, I think for the most part, people are often confused if they think they get a large reimbursement check, they get concerned like, oh my gosh, I have to pay taxes on it. So thankfully, the law is kind of written in our favor, that generally you're not paying taxes currently. Now, there's a big misconception though, because a lot of insurance policies do pay or reimburse you for lost rent, like when your property is being rehabbed and you're not able to receive rent. That is a little bit different than reimbursement for property damage. So the lost rent part is actually taxable. So as a landlord, we want to make sure we are clearly separating the two. Usually the insurance companies do a really good job of it, but that's something to keep in mind on your record keeping. Is this amount of money for property insurance reimbursement, and how much of that is for lost rent?
Something else I was thinking of too was Amanda was mentioning when like new clients come to us, sometimes you'll be talking to them. They're like, "Hey, I had this damage in this property," and they just from a reporting perspective, maybe the person they work with didn't really know how to do it right, so they added the insurance reimbursement as part of rents in their tax return, but then they added the repairs that they paid for as depreciable assets down below. And if you're familiar with tax return, those don't usually offset each other one to one, and so there's the right way to report it and there's the wrong way, and that's one of those wrong ways that you can you think it's going to offset each other, but it doesn't necessarily all the time.
Yeah, let's dig in a little bit more to that. It's like a specific example. So kind of going back to my water damage example, let's just say that you've got a $20,000 claim but you've got a $2,000 deductible. That $2,000 deductible can you write that off on your taxes? Because you're paying for that essentially out of pocket.
Yeah, I think in that situation, that would be something that's probably going to be added to the basis of the property, just depending on the extent of the damage, whether it's, more extensive versus less extensive. But yeah, that would be something you definitely want to capture for sure.
Okay. And then from an insurance perspective, like you're right, because the loss of rent is paid out and it's like a separate payment. So that's usually, not an issue. But if you're let's just say you're upgrading the floor. So let's just say you've got floors you didn't like anyway. They were kind of, linoleum floors. And then you're going back in and maybe putting like a luxury vinyl plank or something like that. So there's, an additional $4,000, $5,000 you're putting into the flooring. Talk to me about kind of what's deductible of that difference.
I mean, so whatever you're going, above and beyond kind of what's part of the casualty loss, usually they're just treated like any other improvements. So for improvements, then you're just looking at, okay, what is the quickest way for me to take depreciation on it? If it's extensive enough, do I do a cost segregation to accelerate the write-off of these major improvements that I'm making? So At that point, it's just very similar to, if you were just making improvements to a rental property in general.
That makes sense. And let's talk about. I'll kind of switch gears a little bit to just putting a new roof on the property. So maybe it's not part of an insurance claim. Maybe you buy a new property. It's new to you, but it is a property that's in need of a lot of renovations or rehabs, et cetera. Roofs, from a insurance perspective, are one of those items that if you proactively, let's just say the roof is old and it needs a new roof, you proactively put a new roof, it can actually make a significant difference in how much you're paying, your premium every month or every year. It can, a new roof is just, it's more durable. You're probably, using materials that are maybe hail resistant potentially, et cetera. So it makes a big difference from an insurance, just what you're paying for perspective. I should say, it could make a big difference. So, but what does it do to your taxes if you're just proactively putting a new roof or improving the property? Talk to me a little bit about just how that works from your perspective.
Yeah, that's a great question. So, I think it's another area that's kind of probably missed out on some opportunities in the tax return. So, obviously, in our example, we are replacing the old roof. There was a roof there before, right? And so, what the tax code allows you to do is to actually take a deduction for kind of the unrecovered cost basis of the old roof. So, you are gonna add the new roof into your depreciation schedule, write it off over a few years, but at the same time you are allowed to write off the old roof. Now there's different ways to kind of calculate what the deemed cost of that is, but that is something I think people overlook because they just forget to write off the old one, they just add the new one. So theoretically you're now depreciating two roofs instead of one. So they do give that opportunity to take that write off, and I think people need to take advantage of that because that could be a big number depending on how much you're paying for your roof.
That makes sense. Okay. And then is there, I'd love just to get like a soundbite about the short-term rental loophole. I don't know how succinctly you guys can just like talk about that a little bit, but I always like having that soundbite with some of the content that we're doing.
You got your elevator pitch for your short-term rental loophole?
we have a transition question from.
Well, I guess fair to say, obviously, a lot of our clients are investing in short-term rentals, and from a tax perspective, they can be really great opportunity if you can self-manage your own properties. There's certain rules you have to meet, but if you can do that, and we can create a loss on paper through doing maximizing depreciation, cost segregation studies, there's ways you can use that loss to offset your W-2, other business income, other types of income, all types of income. So it is a great opportunity for those who are investing in that space.
Yeah, and really the short-term rental investment works for virtually everyone. You could be someone who's full-time in real estate benefit, but you could also just be someone who's working a full-time job, in technology, or you're a doctor or you're a teacher, and be able to invest in real estate, but also be able to use those tax losses that are created strategically to offset all types of income. And the reason for that is, unlike long-term rentals, for short-term rental properties, you just have to be materially participating with the property. That just really means you're meeting specific hours for being hands-on and all that. It does not matter how many hours you're working at your job, which is, one of the hurdles for people who are investing in long-term rentals. You have to have more hours in real estate than your job to be able to use it against W-2 income. So that's why we love short-term rental investing, because like I said, it works for virtually everyone when it comes to tax savings.
That makes sense. Okay. And then just to kind of help our landlord audience and help landlords in general. I know you mentioned, when you're using a property manager, maybe they're entering expenses into some type of bookkeeping software, and maybe things aren't divided out, the most like in the cleanest way. Are there any tips you have or software that you recommend that sort of helps with some of those different line items?
Yeah, the one of the foundations to saving taxes is capturing your expenses, right? And because if we're not capturing our expenses, then we are not writing it off on our taxes. And so, like I said, sometimes people sort of get lazy, and they're like, "Hey, my property management took care of everything. Let me just go ahead and print this report and send it to my CPA." But when you do that, you have to think about, well, what are all the other things that I'm spending money on that's not actually captured in there? So, for example, if I'm paying for different software, is that captured? If I have memberships to Bigger Pockets or other real estate forums, is that on there? I took a trip to some conferences, right? Those are all things that property management company is not paying for. So if you're just using their report, you're not able to capture that. The solution, there's two different things to consider. One is, do you have access to that software that they're using? And if so, are you able to then add in your own expenses in that platform? We don't see that frequently unless if it's like a self-managed platform. So for most of our clients, they keep record on their own of expenses they're paying for personally or out of their LLC. And at tax time, they sort of consolidate the two. So you print out the management report, and then you either put into QuickBooks or transfer to Excel, and then you add in all of your out-of-pocket things like, I don't know, insurance, property taxes, travel, education, things like that. That's not already captured on the management report. And that's what you send to your tax person. So they have kind of a comprehensive list of all of the income and expenses for the real estate.
That's awesome. No, I think that's it's not as quick, I think, as we want it to be, but you want to make sure that garbage in, garbage out. You got to make sure that you're going through it and taking a look at everything, and you've got all of those expenses captured. But anything else you guys want to add just from a tax perspective that we didn't cover yet?
I was just gonna say, continuing the conversation of like accounting and bookkeeping. I feel like we all love to talk about tax savings. It's like very sexy. You buy real estate, you make money, pay less taxes.
That's your soundbite. Taxes is sexy right there.
But nobody likes to talk about bookkeeping. It's kind of like, oh, it's like the bad B word. It's so tedious. But one good thing that we can all do is to create systems and processes so that our record keeping is easier and streamlined. One simple way to do that is to have a separate bank account for your rental real estate, right? So if it's an LLC, the LLC bank account should be used only for real estate stuff. If your rentals are in your personal name, I would suggest having a different personal bank account and a credit card account that's used exclusively for real estate. So whenever you have expenses relating to real estate, it's paid from those accounts. Because that goes a long way at the end of the year to just have to go through those accounts to pick out your expenses rather than going through your personal bank statement of thousands of transactions trying to figure out what did I do, what was for which property.
The other thing I was thinking of too is we're expecting 2025 to kind of be a big year of changes in the tax world, just with the new administration and everything. So I would encourage everybody to kind of stay up to date, and whether it's us or other CPAs, whoever, follow along to make sure you're staying up to date on the information, because we do expect it to change significantly throughout the year at some point.
Yeah, that's great advice. I'm sure there's always something different happening in the tax world year to year. But thank you guys so much. Where can somebody go to find you guys, given it's tax season? Where can investors kind of learn more about Keystone CPA and you guys as well?
Yeah, I mean, the best place for additional tax strategies and how you can save on taxes is just go to our website, KeystoneCPA.com. We have a lot of great free resources. We also have a tax risk assessment tool that you can use yourself just to see what is your risk of overpaying in taxes. But if you're just looking for daily tax tips, the best place to find me is on Instagram as Amanda Han CPA. We also have a lot of really good educational content on YouTube as well as Amanda Han CPA.
Awesome. Thank you guys so much. Thank you so much for joining us at InvestSmart. And we look forward to tax season and getting all of our deductions. So we're excited for that.
Thanks, Alex.